I'm just going to give you a brief overview. As Colin said, I co-founded Metric in 2010. Before that, actually, I was at British Land, where I ran the retail business for 4 years. And before that, I was at a property company called Pillar, where we were, I suppose, the largest owner and operator of retail parks across the UK. So very much retail is in my DNA, although as you'll see from my presentation, we spent the last 5 years increasingly pivoting away from physical retail to take advantage of the massive channel shift that we've seen in consumer shopping behaviours. And 70% of our portfolio today, roughly 70% of our portfolio today, is now invested in the logistics sector. Historically, as Andy probably would have described, as a relatively unsexy part of the real estate market. So just give you a little bit of a background on us, if I've got this to work properly. So, as Colin said, LondonMetric actually was then formed through 2013, the merger between Metric and London and Stamford. And our strategy since 2013 has increasingly been to take advantage of the technological and social change, and that is increasingly driving our sector calls. Distribution, long income, convenience assets make up virtually our entire portfolio today. We've made 2 structural calls. The first, I say, is into the logistics market. The second structural call, or macro call as we call it, has been actually prioritising income and income growth ahead of just being focused on NAV. You know, as the Chief Financial Officer of Unibuy, of those who Unibuy, as you know, Unibuy Road Amco recently merged with Westfield Shopping Centres, has famously once said, NAV is a lazy metric for lazy people. We tend to subscribe to that. We think it's important. But we think real estate is all about income and income growth, and we'll come on to talk about that in a little bit more detail over the next few minutes. We have also consciously rotated out of offices, London residential, and increasingly of multi-let retail. We think there's an awful lot of bear traps out there, and whilst we do our best to avoid the majority of them, we are not completely immune from that. Multi-let retail today accounts for about 7% of our portfolio, and I suspect if I was standing here in a few years' time, it will be materially lower than that. As you can see on the far right, there's a slide that looks at our total shareholder return over the period, which is all very interesting, because if obviously it was going in the other direction, I wouldn't have put it in. But I think what's really quite interesting here is if you look at the 2018 number, 43% of your total return over the previous 5 years has been delivered by the dividends that we've generated and the reinvestment of those. So this is all about income compounding. You know, we subscribe to compounding being the 8th wonder of the world. If you understand it, you will earn it. If you don't, you will pay it. It is undoubtedly the most powerful force in the universe, according to Albert Einstein. So there we are, very briefly. These are the three key pillars of our, excuse the pun, 3 key pillars of our strategy. It's very much, it is distribution, which reflects some of the things that Ben's touched on already. The fact that we think that the UK consumer increasingly is diverting its channel shift online. As you can see there, online sales over the last 12 months up 13%, physical store sales down 1%, and I don't think that will come as a great surprise to you. We'll come on to talk about the logistics market. People want to talk about it as one sector. We actually increasingly look at it 3-dimensionally, mega, regional and urban. And again, as I suspect, I missed some of Andy's presentation, but I think it touched on the powers of long income, the global search for yield in a very low growth and very low interest rate environment. I think real estate has an incredible place to play in this. You know, the idea of being able to own a building that delivers reliable, repetitive, and hopefully growing income is a rarefied commodity, and that will increasingly be the case as the Western world faces this demographic tsunami. You know, today I think 25% of the UK population is old age dependent. That is due to increase over the next 20 years to 34%. There is going to be a desperate search for income across the globe, not just the westernized world. Convenience, we'll come on to talk about that. That is actually just a play on again, how we're changing our shopping patterns. For somebody who's historically had joint ventures with Asda and Sainsbury's and numerous ones with Tesco's, we think that the channel shift is also affecting how we buy food. And as a result, so we've increasingly looked at playing what we call the convenience sector, whether or not it's Aldi, Lidl, Marks and Spencer's, Simply Food. You know, we get very long leases let to very, very good people, often with some form of indexation compounding built into them. It's what we call our low energy investments. And as you can see there, that the market share that the discounters, the German discounters in particular, continue to take from our established grocery retailers who are getting disrupted, whether or not it's, you know, you're watching the video of Jack Ma, but also whether or not it's the way in which we are all buying our groceries today. So looking at how we've pivoted the portfolio, and actually this doesn't... This actually illustrates some of the things I think that Andy touched on, was that historically, if you look at the pie chart on your left, you would see, you know, we had a big exposure to the traditional sectors, retail parks and offices in particular, that would have made up, you know, go back 5 years, that would have made up probably 80%, if not more, of IPD. And what we've done is we've pivoted increasingly into the logistics market. As I said, we look at it three-dimensionally, mega, regional, urban, and then with the convenience and long income making up the rest of our, predominantly the rest of our portfolio. And as a result, that net rental income number there that you actually just see, that we haven't gone from 58.5 million to 9. It actually would read 90 million. So you can see the pivot away from low-yielding London offices, low-yielding London residential into more greater income focus has allowed us to increase our income by over 50%. And we think that that is entirely appropriate for the current investment horizon. We actually believe that income will dominate the your investment returns for the next decade. Then looking at our rental income, I mean, one of the things I think real estate has a terrific place to play. The problem with it is there's a couple of things. Leases get shorter, rental growth doesn't happen, and buildings get increasingly obsolete. And I think those are things that can interrupt your returns, and that is certainly the case in some of the more traditional sectors of office and multi-let operational retail. One of the things that we've consciously set out to do is to guarantee rental growth. 50% of our income today comes from some sort of built-in contractual rental uplift, whether or not it's a fixed uplift or whether or not it's an index rent review linked us to inflation, whether or not it be RPI or CPI. And there you can see 50% of our rent is subject to the traditional open market rent reviews. And I think that income growth is going to be, as say, a defining characteristic across the sector. I mean, if you look at the traditional property market today, there's I think outside of what I call the alternatives, self-storage, student, PRS, but healthcare and logistics, it's very, very difficult to see any organic rental growth across the market. And I mean office, the complete suite of office markets, whether or not it's not just London, but also the southeast, but the whole of the UK. And I think the same is in retail. I think that, the channel shift, together with the failure of a number of operators to right-size their store portfolios, and together with this thing that we call the upward-only rent review clause, means that we are in a situation where rents across all of retail is at elevated levels, which is largely unsustainable. I've studied the CVA documents from New Look, from Carpetright, Mothercare, and even Carluccio's, and I'm trying to find a correlation between prime or secondary or geographies, and I've come to the conclusion that it's indiscriminate. I don't think prime is good, secondary is bad. I don't think experience is good and convenience is poor. I don't think it's about needs versus wants. For us, it just looks fairly indiscriminate, and a large part of that is because the real estate sector has been quite happily enjoying the benefits of an upward-only rent review clause over the last 20, 25 years, which doesn't account for two major shifts that have taken place over the last decade. One, a global financial crisis, and two, a massive channel shift to online sales. The distribution portfolio across the UK, and this doesn't have to be, this isn't specific to us, it's very much a hub and spoke model. And the hub being your mega distribution centres, not that there is a typical blueprint for retailing, but you'd end up with probably two massive hubs, one just north of London and one up in somewhere along the M1, probably in somewhere in Yorkshire, Doncaster or Wakefield. So that's your hub. And what we're finding now increasingly is retailers needing to put in more spokes into that hub. And those spokes will be around the major urban populations in order to meet your rising delivery expectations. You know, the UK consumer is world-class at internet shopping. Okay, we are absolutely, you know, if there's a World Cup on this, we would be the winners. Okay, and as a result, our expectations continue to rise. You know, what I said in our recent results presentations, what was yesterday's wow is tomorrow's norm. You know, 3 years ago, a 2-3 day delivery slot would have been fantastic. And today we're talking about, well, we want it this afternoon. And in order to do that, retailers are having to put, and 3PLs as well, having to put more spokes into the hubs. And the spokes are, you know, surrounding the major cities, Edinburgh, Manchester, Leeds, Liverpool, Bristol, and obviously London. So urban logistics has been a growth. I mean, it's quite often referred to as last mile. And that will continue to grow. I mean, you know, that upstart that arrived from Seattle a few years ago has you know, increased our expectations. You know, Amazon do an unbelievable job. You know, they've created a brand in a very short period of time that we trust to deliver when they say. They've created a brand that we're comfortable to pay, but also they've created a sense of security that if we don't like what we've ordered, for whatever reason, we can send it back. And one of the things that people do tend to forget is that whilst online delivery is increasingly important, reverse logistics is a growing market. And that continues to drive volumes. And I don't mind if you order 10 and send back 9. For me, it all requires more warehouse space. So you just keep pressing that button. When you look across then at the bottom, sorry, I'm colorblind, I think it's the bottom shaded area, we show some of our expectations for rental growth across these sectors. We guide on mega rental growth of between 1% and 3% per annum, and that's a triple net, that's clean. You can compound it for the next 5 or 10 years. In urban, where land is in shorter supply, where there is competing uses for that land that is undoubtedly going to be more valuable than a shed that's probably let at £5 a foot. And everything you can think about that you could put on that land that isn't a warehouse will be more valuable. Whether or not it's a car showroom, self-storage, student accommodation, retail parks, and obviously residential. So land is in short supply, the consumer expectations are driving demand, and as a result, we anticipate net rental growth across this urban logistics sector at somewhere between 3% to 6%. Now, I don't know if that ties in with what you read about from the so-called experts across the consultancy world, but that's certainly our own experience. And then regional sits between the two. Regional, I mean, the biggest player in the regional market is Amazon. You know, they dominate that market. I think last year they would have accounted for nearly a quarter of the total take-up across the UK. It's a great sector, but that again is also is nearly quite as competitive as we're finding the urban logistics market. Interestingly here, what we have done is fused our relationships that we've built up in retail over the last 30 years to give us, you know, some sort of competitive advantage against some of the competitors that we come up against. You know, you can see it's no coincidence that, you know, our major customers in mega distribution are retailers. It's no coincidence that, you know, in urban logistics we continue to focus on trying to extend those relationships into their spoke strategy, you know, with Dixons and Tesco's in particular. But undoubtedly, urban will be dominated, as you can see at the bottom there, by what we call the 3PL, the third-party logistics operators, where, you know, DPD, FedEx, GEFCO, TNT, and of course DHL. So looking then back to retail, people want to tell you that all retail is bad. It is not. There are pockets there where we think that we can deliver returns that to our shareholders. Predominantly dominated by income and the compounding of that. As you can see, long income for us is, you know, 12 plus years let by and large to single tenants on 15 or on leases increasingly linked to some form of RPI. Our retail portfolio today is 100% occupied across all three silos. Our long income is held increasingly in joint ventures. USS is the largest occupational pension scheme in the world, in the UK. They are attracted to this because they need income to pay their pension holders, and that is the role, as I touched on earlier, that real estate can play if you choose the right sectors. Convenience and leisure, increasingly dominated, as I said earlier, by the food operators, that what I call the disruptors in a different way, the Aldis, the Lidls, and the Simply Foods. And retail parks, it's a good market, but it's a market that has been over-rented for the last 10 years, and as a result, our exposure to that sector will increasingly dwindle. Investment activity, I don't intend to spend a lot of time on this, but fair to say, and what I've said already this morning, is increasing focus for us on urban logistics. That is a market where we actually think that it's a very diverse sector, and we think that there are attractions for consolidation. We think controlled development has its place in a UK portfolio, but again, as a REIT and a high dividend payer, we believe that as I say, has to be controlled, and it will certainly never exceed 10% of our portfolio. And we continue to pivot out of operational retail. We will continue to look at selling assets where we believe that the market's expectations of returns from those assets will be ahead of our own. So before I wrap up, a couple of slides here, one on the occupier market, one on the investment market. The strapline here, we are no longer a nation of shopkeepers. Consumer shopping habits continue to change, as I've touched on, and Ben has already touched on already here. And we think that the way to play this is increasingly through the logistics platform. We think retail is highly challenged. We think there is a clear and present danger to your current valuations of your retail assets. Permanent and profound structural changes have taken place across the retail market, and that will continue. We think that retailers have to adapt to survive. We think a number of them have left it too late, and as a result, CVA or administrations will be the only option. We believe that rents will, by and large, continue to fall, irrespective of the upward-only rent review clause, and the reason that will happen, it will even happen during a CVA in administration, or indeed at lease expiry. For those of you who haven't had the pleasure of reading Simon Wolfson's CEO review at the end of January on Next, I couldn't recommend it more highly. He talks about 19 lease renewals conducted through calendar year 18, where his average rents fell by 25%. We think that is we see that as our central case for large parts of the retail market. And then moving on to the investment market outlook, I think Andy's already touched upon the fact that volumes are going to be down, but it is a polarization. I think there's the limited liquidity in some of the traditional sectors, particularly shopping centres. And it is a case of the rise of the alternatives. As I said, students, PRS, logistics, healthcare. And we think that, as I say, the tectonic plates in retail will continue to shift, which makes monetizing some of those assets more challenging for some. Income will continue to take centre stage. We think that the compounding strategies of true REIT behaviours will outperform the hyperactive strategies of the REIT pretenders. Development and trading strategies we think will be outmanoeuvred by the compounders. And the demographic surge, the demographic tsunami that's taking place will continue to prolong this trend. As I said, liquidity continues to polarize. We think that low energy assets will continue to be in demand, particularly from occupational pension funds, providing that the lot sizes are palatable. And for that, we read in 30 million or below. We think the air tends to get a little bit thinner when you start to move above that. And increasingly for these investors, it's non-operational. They're not interested in running multi-tenanted platforms. They're not interested in running service charges. They're looking effectively for a bond proxy. It's 4 checks a year, and if that rises with RPI, all the better. And so we finish with our outlook. We call it the killer Ds. We think there will be continuing digital disruption. We think that the demographics will continue to drive real estate trends. We think that distribution is a winner in this. And for our shareholders, increasingly, their returns will be driven by their dividend and the compounding of that dividend income, particularly for the next 5 to 10 years. So on that note, I will wrap up and I suppose invite you to join us for some Q&A. Thank you very much.